Ask your question again.
How do you determine which one has more premium? Or what causes more premium on the put side versus the call side? Like let's say 15 points away from the strike on either side.
Well, the puts tend to pay a little bit better than the calls, and that's because puts are when it's going down, and people are more geared towards fear, and calls take a little more effort to go up. So as far as trading, there's always going to be a heavy put side because that comes fast and furious and it comes down. You know, when you look at the market going up, we use candlestick. Each one is let's say each one is a week. This is a whole year. 52 candlesticks. Looks like this, right? This means it was a big trading day, up and down, right? The market kind of goes like this. It creeps up slowly. And then when you have a down day, like that. Exactly what happens. And then people pulling their hair out, the market's crashing. And this is when the big traders get in. We're gonna get in now. And if you think there's manipulation, there is. You know, the big traders say, hey, let's call Carlos. Hey, we're gonna buy Netflix. And it goes up. We're gonna buy Apple. New high. And then, hey man, it's time to sell. Call your buddies. And then, here it goes. Right? And look at this. We're at buy point. See this? This is support. Understand, because it's been here 3 times. Right? Here, this is resistance. But we're still on the trend. This is a trend here going up. Right? So now, it came back down. So now we're at support. So now we buy. Call your friends. What happens? It goes up. Puts tend to be, if a put is 50, a call will be like 48. So it's a little different at the same price. But it tells you the price when you pull up your option chain. It tells you how much the put is, how much the call is. Right. And the one you write or the one you buy, hopefully you're writing puts, but you can buy too. Like we're buying that hedge on the portfolio. That's what you're going to pay. You're going to pay the price, whatever it is. So if you're writing naked puts, you're going to get that premium. If you're writing cover calls, you're going to get that premium, whatever it says. So the higher you go, like say for a call, if your stock, if Amazon, right, $14.95. Say you want to buy the call. So there's 50 points, right, for the right cover call for the 1520. 1520 call, 1 month out. April was 48, right? We just did that, right?
Yeah.
So you're gonna pay $4,800. You're gonna control 100 shares of stock. You know, 100 shares of stock we know is $149,500, right? But we're gonna put $4,800 to control 100 shares of stock. That's when you buy the call. When you write the call, you're going to collect this money to have the responsibility of that stock. Questions? You know? So get ready, because it takes a long effort for it to go up, but then it comes down fast and furious and easier. Fear is just more powerful than confidence in the bad market.
So let's just look
Takes time to
let's
build
look
up.
at the chart there. What's the typical thing that's happening with the beginners and the pros? Pros are buying.
Well, what happens is opposite what you think. You want to become a contrarian when you trade the market, because when the stock goes up, hey look, Amazon's going up. You know, look, it's going up. Let's get in. It's doing great. They get in right here. And then what happens? Oh, it came down some. Oh, okay. It's okay. It's going to go back up. Let's go back up. Hey, look, we're up here. You know, And this might be, let's say this Amazon. This might be 1,400. This might be 1,500. This might be 1,600. Okay. What happens is the big traders are buying the dips here, here, and here. Okay. And when it goes up, they're selling here. They're selling here. They're selling here. Okay. They're cashing out. They're buying literally at 1,300. Okay. And they're selling at 1,500. And they're the ones who cause this stuff to come down. When it comes down, the big gauge goes down a lot. Oh, some big traders selling. They're just making money. That's what they do. So the small trader will come in at 1,300 and say, "Hey, doing great. Now it's 1,400. That's great. Awesome. Let's celebrate." And then it comes down. They go, "Oh, well, back to 1,300." You know, go up. And meanwhile, the big traders just made 100 points.
And then
The small traders still inside the stock.
but on that way down, and the small traders a lot of them are unloading because they're paying.
Maybe. It's mostly big stock, big boys are selling. The small traders don't have a big, collectively they do have an influence on the market. But the main move of the market is the big traders. So in this case, the plan in their mind was, we're gonna buy Amazon, and it's gonna go to the moon, so we go to 50,000 a share. They don't care, no plan. No action plan, no nothing. They just throw their money into it. So they get half of it as 1,400. Big traders sell back to 1,300, okay? This is the buy point, right? Another buy point here. Let's say this is 1,200, okay? And here it's 1,200. Hopefully it won't go back to there, but it can. Always know that it can go below you where you think it can go. So now, when it gets up here, climbs up and up and up and up, the big traders are buying. When it gets here, the small trader had no game plan, had no nothing. They're just holding. Hey, it's doing great. They had no idea when they want to sell. Maybe they'll sell when they make 1,000 points on it. The big trader says, "Hey, we made 100 points. We made 200 points. Let's sell." Bam, 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 bam. And now we're down to 1,200. Okay. And this is when the small trader unloads, when they're in fear. They got pushed out of the market by the big boys. It was at 1,500 one day, it's at 1,200. This is a general market too, the same thing. Doesn't matter what stock. Now, it unloaded quick, it's low, and the small traders are afraid and they sold. They got in at 1,300, they sold at 1,200, and they got hurt. Got emotionally hurt, they leave the market. And this separates the men from the boys. And sometimes they don't come back. They got hurt, you know? And the big traders were like, "Hey, it's not 1,200.
It's unsafe.
I'm running cover calls, I can't lose." So, it goes back up. And then the small trader goes, "I sold at 1,200, now it's 1,600.
So they started buying.
And then they get back in. At 1,600, and then down. And the big traders unload. Look, we're making money. See, this big trader has a plan. You get in at 13, you sell at 14. Get in at 13, you sell at 15. That's a plan. Just plan it out. Like when you want to buy a stock, plan out when you're going to exit. Because you'll hit that point, and you'll be tempted. Hey, let's stay in a little longer to make more money. It's tempting. It might go up more. And what probably happens? Comes right back down. So you have to stick to your plan. And the big traders need to make money to keep their jobs, to keep making money, to keep their customers. So they have to sell at a certain point. Their boss will fire them if they mess up too much. So they're going to be smart and they're going to make a small amount. See, the big traders only want to make 100 points or 50 points or 20 points. They might have 1 million shares collectively. But the small trader, they're trying to make a lot more because they're trying to make money on 100 shares or 50 shares or 25 shares. So they have to move 1,000 points when they make any money. So the market favors big accounts, favors more shares. So a big trader may have 1 million shares. Can you imagine Amazon? There's 5 million traded a day. You could have a million. So, Chris, how much money do you want to make? And you have 1 million shares of Amazon. How much money do you want to make? You're a big trader. You're a big trader.
$1. I just
$1. How much is $1?
$1 million.
$1 million. Not bad for a day trade.
Imagine though, on 1 million shares, because that stuff moves by $20
You'll get $1 million on the first 30 seconds of trading Monday, I guarantee you, because it will spike up. And then what can you do? Just take a break, go to the Caymans, come back next month and do it again. Now, a small trader might only have, 30 shares. So he can't get $1. That will make him $30.
Easy, yeah,
So you see how much of an advantage you have when you have more shares?
yeah.
So if you have 1 million shares, you don't need to make a few points, and if you're doing it right, you're gonna make a lot more anyways. And they cause the changes in the market. They cause all this stuff to happen. So in a way, it's manipulated, but it's manipulated by a trader who has more money, more shares. So in that way, it's fair. Questions on that? So consider, instead of when it dips, instead of trying to sell and get pushed out by the big boys, consider buying. Because, and then if you want to sell, you want to trade when it swings up, when it's doing great, when everyone's getting in, that's when you want to sell. That's option 1. Option 2 is just to hold the shares and write cover calls. Let me tell you the downside of cover calls. There's two downsides. One is loss of share growth. That can happen with any stock. It's doing great, and then it comes down. So let's do Netflix. We already have the stock at 300. We're at 315. We're at 315 for 12.50. Right, credit, right? Per month. Purchases here, agree to sell here for the cover call, 1 month out, April, 1 month. So what's going to happen is, stock's going to swing up to 310, 315, 320. You're going to get that share growth. You're going to get 15 points here, or $1,500, which is maximum you can get is 1,500 plus 1,200 here is 2,750 maximum growth, because you're agreeing to sell the shares at 13.50. So the stock swings up to, give me a price higher, way higher.
330.
330. You're going to make the distance between this one and this one, which is 15 points. You're going to make the 12.50, which is 27.50 total. But beyond that, you're not going to make any money. If the share is going to sell 315. You're going to lose out on 15 points of opportunity. Opportunity loss.
Wait, now that math is wrong right there, isn't it? 1,500 plus 12.50 is 37.50, right? Not 27.50?
No. It's 15 points here.
Right, so it's
And
1,500
then 12.50
plus
here.
$12.
27.50. Right?
Oh yeah, that's correct. That's right. Sorry.
The 330 is, if you didn't write the cover call at all, you'll get 3,000.
That's right. Never mind.
So the total would have been $3,000 you would have made. So you're actually out $250 for writing the cover call. But here's the thing. I'd rather have $27.50 in my hand and $12.50 in my hand up front for writing the cover call than the opportunity of 330, which may never come. It may not go up 30 points. But once you write the cover call, we're going to get this 12.50 for sure. That's determined. The premium, the share growth.
Yeah, for sure. Yeah.
The share growth is
I
not
thought
determined.
I thought it would come out a lot more. That's really only a tiny bit more than you get. having the share.
But remember it moved from 200 to 300? Remember Netflix? Netflix went from 200 to 300 in 60 days. So if you had a cover call on that, you were right here right at 200. Let's say you're getting 12.50, so you're getting 212.50, right? But now stock goes at 300, which it did. So now you're out opportunity. You got to 12.50, so now you're out 87.50 on that 1 month.
So you could have made an extra
which is
$9,000.
$750. So you took $1,250 in hand for opportunity, which did come at $8,700. So in this case, you lost opportunity. This is gonna want to never want you to make you never write a cover call, because to lose all that growth.
But usually though, that's kind of rare, that kind of jump. I mean, that's a 33% jump, right?
Yeah, that generally will never happen, but it did happen. And the thing is, I'd rather take my $1,250 a month every month, and we already decided that after 2.5 years, it's going to add up to your $300 stock price. But I take $1,250 a month, determined income, than to take 100 points of opportunity, which may hit, may not hit. It won't hit every month. Your $1,250, that comes every month. Premium, cover calls, naked puts, that comes every month. Like clockwork. When you press the button to the right, you get the money. But the share growth, it may not come. It's only opportunity. It's not determined. So it's like the thing, better to have a bird one bird in the hand and 2 birds in the bush. Better have one in the hand, you should have one. Got that? That's a good session.